All right, the first concept I want to talk about is the primary mortgage market. Now, understand we got to have both, or otherwise you and I don't have a job, right? So if you're a real estate professional, you depend on loan officers to help our buyers with loans. We need companies for refinancing of loans. We need the secondary mortgage market to buy those loans. So without both of these markets, you and I as real estate professionals, we just don't have a job. All right, but we have to know the difference between the two. The primary market is the frontline loan people. They're the loan officer at the bank or the mortgage broker that we send our buyers to or that we go to refinance a loan. They're the ones who fund the loan. They're the ones who are taking applications and doing the qualifications and whatnot. The secondary mortgage market is where those loans are sold to after closing. And we have to know a little bit about both for our exam. Now, the primary mortgage market exists of companies like savings and loans, insurance companies, commercial banks, pension funds. If you see the list of primary mortgage markets that I have on your screen here, you'll notice that just about everybody and their mother are now in today's world providing loans. Even the states have got involved. Number 8 there, state housing bond market. So what some of the states have done is they issue bonds and they sell those bonds to investors, and then they use the money from the sale of those bonds to fund loans. Now, typically, those loans are for lower socioeconomic type borrowers. However, everybody, including state government, is getting involved in the mortgage market, if you will. So these are the companies and the entities that generate the business. Now, the secondary mortgage market is where those loans ultimately end up. And later on in the video, I'm going to do a schematic, a process schematic of how it all works. But there are a couple of entities that we really need to know for our licensing exam. The Federal National Mortgage Association, which is commonly known as FNMA, it was specifically created in the 30s to buy what's called the Federal Housing Administration Loan, or FHA loan. Now, in my next video, we're going to talk about specific loans like FHA loans, but that's what it was originally designed. Now, it has broadened its base a little bit as the decades went on, but it is a large secondary mortgage market that purchases those government-backed loans. Freddie Mac is another one. Now, Freddie Mac recently changed its name a few years ago. It's formerly known as the Federal Home Loan Mortgage Corporation. And it was created to purchase conventional loans, or those non-government-backed loans. And then we have a third term you have to know. It's called the Government National Mortgage Association, which is commonly known as GNMA. And GNMA is actually a government entity. It's a government agency that works under the Department of Housing and Urban Development. And it's a government agency, and it issues certificates backing the mortgage-backed securities industry. You don't need to really know too much more other than that, but these three concepts or these three entities you do have to know something about. Now, here is how the secondary mortgage process works, and I have it on your screen. The borrower walks into the bank and says, I want to refinance my house or buy a house. The bank, who's the lender, they take the application, they schedule the appraisal, they ensure that the borrower is approved or qualified for the loan amount that they need. They apply the guidelines that have been written and established by Freddie Mac and Fannie Mae. And if the borrower is qualified based on those guidelines, including income and debt and all of that, then it goes to closing. The lender will facilitate the closing, make sure all the documents and everything is done correctly and signed and recorded, so on and so forth. And let's say that the lender, 12th Street Mortgage is our lender, and it's a $250,000 mortgage. Well, they're going to originally fund that transaction. So 12th Street Mortgage is going to cough up $250,000 out of their coffers to fund that transaction. But obviously, they wouldn't be able to do too many loans because quickly that whole pool of money that individual lender has would dry up really quickly. So the mechanism of the secondary mortgage market is to sell those loans to that secondary mortgage entity so they can always keep those coffers full of money to originate loans. So the lender is going to do a couple of things after closing. The lender is going to do what they call packaging or warehousing a bundle of loans, depending on the loan size. What happens typically is if it's residential loans, they will put 15, 20 different loans together in one package. They call it a mortgage portfolio. 15, 20, $25 million in residential loans. Then they pack as a package, they will then sell it to the secondary mortgage market, to Freddie Mac or Fannie Mae, depending on the type of loans. And as you can see on your screen, what technically happens is 12th Street Mortgage is going to assign the rights to that loan or all of those loans over to Fannie Mae or Freddie Mac. Now look what happens as you can see on your screen. Then Freddie Mac or Fannie Mae then puts the money or they basically determine the value and give that value back to the lender. So then the lender has more money to generate more loans, and that cycle just continues. Now, there is a key term I have highlighted at the bottom you have to know. It happens between the process where the lender is selling the portfolio to, let's say, Fannie Mae or Freddie Mac. What's going to happen is there's going to be an Estoppel certificate that is issued. Now, an Estoppel certificate is a document that verifies that the loan terms when the loan was made met the guidelines of Freddie Mac or Fannie Mae. They met the guidelines and there was no shenanigans. It is a certificate that basically says we verify that these are good loans. All right. An Estoppel certificate can also be used when an investor, typically not with residential investment property, more so with like big dollar investments like commercial properties and industrial properties, those type of things, where a loan could be 10, 15, 20 million dollars in and of itself. So what's going to happen is an Estoppel certificate is sent out to all the tenants. And all the tenants will verify the remaining amount or the remaining term of their lease and also the monthly rents. Because if I'm a lender, I want to verify that if there is a commercial space with 10 tenants in there, I want to know how long each lease, how much time is remaining on each lease, and what's the value of that lease. That's important to determining whether or not this loan is going to be made. Well, that document that's used is called an Estoppel certificate, and you need to know that term in particular for your real estate exam, right? So that process happens, though, between the time that the lender packages up the mortgages and sends them off to the secondary mortgage market. Before that money is transferred, those Estoppel certificates are done. That's how the process works. All right, so here's another schematic you have to know. And that deals with what happens once the lender sells that mortgage or that portfolio off to the secondary mortgage market. Well, so what happens is the borrower starts making their monthly payments, and they're going to make their monthly payments to whoever they're told to make the monthly payments to. It could be Wells Fargo, US Bank, or anybody else. The key to remember, the service provider may or may not be the person who owns the loan. So you may be making your monthly house payment to Wells Fargo. However, Wells Fargo doesn't own the loan. An investor owns the loan. You'll never know who owns the loan, but you're making your mortgage payment to Wells Fargo, and then Wells Fargo then takes a small service fee out of your loan payment and then sends the rest off to the investor, or what we call a mortgage holder. I was at a conference once, I don't know, 5 or 6 years ago, and Wells Fargo and U.S. Bank and all of those type of folks were there. And Wells Fargo made a comment that only about 20 or 21% of all the loans that they service, they actually own. They were 79 or 80% of the people that were sending their mortgage payments to Wells Fargo were actually just, they were servicing the loan for somebody else. I always found that interesting. I don't know why, but it's just kind of an interesting concept. So that's all right. So don't forget, my next video I'm going to do is going to be on the specific types of loans, like the Veterans Affairs loans and the conventional loans. So that'll be another good video for you to view. But in the meantime, if you're going to continue to study, check out this video right here. This one's going to be very helpful. And hey, by the way, if you have not subscribed to our channel, please do so. Click on the little circle to my left. I would appreciate it. I will see you in the next video.